Now, joining me today to discuss the key considerations of the MPC and the implications for financial asset investment is the head investment research at Afrinvest Securities Limited, Robert Omotunde. Good morning, Robert. Thank you for joining us. Well, we have seen the decision by the Monetary Policy Committee to hold rates. That's in line with consensus. Did you see any reactions from the equities and the fixed income markets yesterday?
Well, the meeting has come and gone, and like you rightly said, the committee decided, to keep all policy rates, at the levels they were. So MPR is still at 14%, CRR at 22.5%, and liquidity ratio at 30%. The market had expected that largely the committee would favor the decision to hold rates, and this is in line with what our expectation was, even at Afrinvest, in terms of the global conditions, the current run on emerging market assets, which saw yields rising significantly in major emerging markets, coupled with the fact that within the domestic economy, even though we have improving global oil prices, we've also seen that most foreign investors, for about 2 or 3 weeks now, we've seen the run, for safety by most of the foreign investors, which is also pressuring what we continue to experience in terms of activities in the foreign exchange market. So these are factors that the committee considered, like I said, which is in line with what major consensus expectation was. And so the decision was not really surprising to the market. It's just this is the morning after the decision was taken. The communique was read at about the time the market was closing. But again, what we would expect today would be the status quo, because market was not really expecting, maybe market would have been surprised if there was surprisingly, we saw that the committee decided to, one member of the committee voted for
a hike. I was wondering.
But again, it's the beauty of economics and how, people can marshal their points to defend whatever position. Those who believe that they should continue to tighten, they will, of course, advance some economic arguments, to that effect. But the market, I believe, is happy that all rates were kept. In the fixed income market, we'll still continue to see, you rightly mentioned this in your introduction, yields are continuing to trend downwards, and this will still continue to play out, notwithstanding the level of the MPR at 14%. You would, before 2015, you could argue, that most market rates move above the MPR, but that's not the case here. MPR is at 14%, and you see average market rates trending below 14%, 13.4 for long-dated instrument, and 12.4 for the shorter time instrument. In fact, in the secondary market, yesterday and the day before, we saw rates as low as 10.5%. That speaks of what is happening within the economy, notwithstanding the decision or the stance of the MPC to retain the rate at 14%.
Okay, the central bank governor, while presenting the communique, noted that it's important for a gradual release of funds towards the implementation of the 2018 budget in order to prevent negative shocks on price level. What's your take on that?
Well, we think what the committee noted is apt, in terms of, we've seen this delay in the passage of 2018 budget. This is becoming more like a norm, where you see delay up until May or June. May is wrapping up now. We are entering into June, and it looks like the passage will be coming sometime around the middle of June or early June, as the case may be. But of concern is the fact that up until June, we've not seen deployment of funds or release of funds for the 2018 budget. So the committee was rightly concerned that by the time we see this, this may increase the level of liquidity in the system and of course create some inflationary pressures. The likely or the usual traditional argument which we make, that is inflation being always a monetary phenomenon. But I think the better perspective, to look at this issue will be that inflation in Nigeria, for example, has always been cost driven. It's always been cost push. The argument for the release of funds, you note that when the funds are being released, or when we claim that budget has not been passed, is usually in the area of capital spending. More often than not, you say that salaries will still continue to get paid. I mean, there's a law that allows them to spend up to a certain percentage of the previous year's spending. So people have been paid their salaries, even though 2018 budget has not been passed. But when this passage finally comes, what you will see is deployment of funds into capital projects. Now, the argument will now be how much of inflationary impact can, even if these funds, which was what the committee was talking about, even if they were released, in large chunks into the economy, what is the absorptive capacity of the economy to accommodate all of this without necessarily, influencing domestic prices? Because we know the transmission mechanism through which prices, get pressured, especially from the perspective of funds flowing into the economy. The argument will be that more spending in the economy has more capacity to, in Nigeria, you can argue that exchange rate has always been most effective in the pass-through to prices. So more liquidity in the system, the worry will be through majorly how it affects the exchange rate, which is already being pressured because of the demand. You will notice that over the last few weeks, we've seen that pressure coming from the demand side into the foreign exchange market, and of course, the committee noted it, during the communique.